The historic US shutdown that has been in place over the last month and a half is officially over, with Donald Trump signing the bill that will refund the government up until the end of January anyway. So this really is an opportunity for us to gauge exactly what the impact is on markets, what the impact could be down the line, considering this is just a temporary reprieve, and whether we're just going to be back in the same situation in a couple of months' time. So, of course, the agreement really seemed to hit on the weekend. Last Sunday just gone, we saw the Senate essentially finally break, where we saw a number of Democrats moving over to the Republican side, voting in favor. So it came into a 60-40 vote. That's really where we saw the major market moves on Monday, most notably the big tech names that we saw really outperforming over the course of Monday. We've seen mixed trade since then, really, and there's question marks about of course the longevity of this deal, considering that it's just a temporary reprieve passing us down to the back end of January, but nonetheless I think there's reasons to be optimistic that it won't necessarily be just that. So first and foremost, it was not a 41-day shutdown, it was longer than that, but as you can see here, it's the longest shutdown in the history of the United States. And you can see second behind that is the 2018 event, which was under Donald Trump as well. So I guess you might say, well, he doesn't really mind brinkmanship and taking it to an extreme, which we've already seen in other situations anyway. And so that raises question marks over exactly what might happen in January. And you can see here, this extends the funding until just January the 30th. It restores funding for SNAP benefits, reverses the mass firings of federal workers, but crucially, no deal on the expiring health care tax credit. So this Obamacare tax credit issue will be voted on in the coming weeks, and that's one of the things that has allowed some of the Democrats to say, okay, fine, we're not going to get much more than this. I don't necessarily think they're going to suddenly get the support to extend the deal. So that's going to run out at the back end of the year, a month before this funding deal runs out. So that's crucial, because if they do manage to essentially move that issue off the table by the time we see this funding issue come back into play at the back end of January, then it's just one less thing. And in actual fact, the major thing that has been a hurdle within these discussions and these negotiations, that is in part why I think it's less likely we're going to see a long-term shutdown at the beginning of next year when this runs out on the 30th of January. Essentially, the Democrats have wanted to show that they have the backbone to be able to put up a fight against Donald Trump, considering the fact that they lost so heavily in the elections. They've done that, but it's come at a cost, of course, and certainly it just came to a point where it was no longer defensible. You can see in terms of the economy, of course, there have been different estimates on how much this is going to cost to the US economy. Some put it at around about $10 billion per week of GDP. Some put it at $30 billion, but certainly there will be a knock-on impact. Now, it's an interesting one, because you might remember that it wasn't so long ago that Donald Trump was saying, oh, I want companies to report less. Maybe we'll get them to do it every 2 quarters rather than every quarter. And he fired the BLS chief and started to say, we get too much data too much at the time. It's really confusing. It causes volatility. We should just take a long-term view. So Donald Trump's all about vibes, not necessarily data. He can tell you that everything's going perfectly. He doesn't want you to see the reality and the stats behind it. Although the caveat here is, you could say, well, look at the revisions we've seen in terms of the jobs numbers. The first number might not even be the true story on what's happening in the economy. But nonetheless, what this shutdown has done is provide the basis for us to see a blackout, because it looks like we're not going to get both jobs and inflation reports from that missing period. So that raises question marks around what the Federal Reserve are going to do as a result. But it also provides the basis for Donald Trump to say, well, any weakness at the back end of the year can just be explained by the shutdown. It was the Democrats' fault anyway. They tried to play a game of brinkmanship with me, and it's never going to work. And look at what's happened now. They've damaged the economy. You want to stick with me, it'll be great. Q1 is going to be the best quarter you've ever seen. That kind of thing. But essentially, we can expect poor data at the back end of the year. But markets, I guess, will likely look beyond that, because they do know that anything they can really attribute to this shutdown will likely be a short-term phenomenon. In terms of the New York Fed, their latest GDP nowcast puts growth at 2.1 for the fourth quarter. That's informed by the latest ISM numbers, latest ADP numbers. So a bit of weaker growth, but by and large, like I said, I think if markets see weak data, I don't necessarily think that they will think that suddenly the economy is collapsing, but they might think that it's the kind of thing that could help the Federal Reserve make their decision towards a rate cut at the back end of the year. Notably, the main thing that really got things moving was the breakdown in terms of air traffic in the US. Over the course of the weekend, thousands of flights cancelled. That has dialed down a bit. But certainly, you know, as we come into the Thanksgiving celebrations, the idea of Washington's disruption, essentially meaning that people can't travel to see their family, definitely not a good story. So that's one of the main reasons why we actually eventually saw them come to the table and find an agreement. Some would say that next time around in January, there isn't a Thanksgiving to stop things. But in any case, I think the cancellations of thousands of flights is a bad story with or without the Thanksgiving holiday celebrations. And this really is a highlight that, like, you can shut down for a week or two and not much happens. But the longer that the shutdown goes on for, the more you see things break that haven't broken before. Excuse me. And this is an example of that. So, you know, we now know that it's highly likely that if we see a long shutdown like we have this time around in the future, then airline stocks are probably likely to suffer as a result, because there's a fear that suddenly many of their flights are going to have to be cancelled. So in terms of the market implications, it's notable that over recent occurrences of shutdowns, and remember, you know, shutdowns may seem very regular now. They weren't necessarily so in the past. You can see between 2018, the one before that, Obama, so it was a 5-year gap. Before that was an 8-year gap, and then a 5-year gap. So 5 years, 8 years, you know, it's not necessarily super regular occurrence essentially. But the more recent ones that we've seen, generally, if you look sort of a month out, by and large, out of the last 1, 2, 3, 4, 6. So out of the last 6 occurrences, you look 1 month after the resolution of the shutdown, and the S&P 500 should be significantly higher. It's a little bit more mixed when you're looking over the course of the next week. So of the last 6, half of them were positive. And we're seeing that at the moment. In actual fact, you know, equities certainly popped on Monday, but certainly fading a little bit now. In terms of the trajectory for gold, 4 of the last 5 times has been higher a month later, and 4 of the last 5 times has been higher a week later. So generally, despite the fact that shutdowns can be perceived to be positive for gold, in actual fact, it's also generally positive once you see the resolution, which is exactly what we have seen this time around. Another way of looking at it is with a longer term view. This is the breakdown according to what is the performance for the S&P 500 for the 12 months following the shutdown resolution, and by and large very positive. But you would say generally markets trend upwards, so that's probably to be expected to a degree. But certainly, you know, the resolution of these shutdowns are always, or not always, very regularly a positive event. And that's in part why when we saw the shutdown, we didn't necessarily see a major collapse in terms of equity markets. In terms of the market that's really been in the limelight recently, I would take a look at the Nasdaq. So I know we were talking about the S&P 500, but this is the Nasdaq because it really has seen the significant volatility of late. So the pop that we saw on Monday is here. So there's the reopening this week. We saw that initial rise. We haven't taken out the 25752 level, and potentially a little head and shoulders formation. So we might actually start to fade, despite the fact that we've now seen the confirmation that the shutdown has ended. And in part, the way that I see it is, I think it was going to pop even if you didn't see that announcement, quite frankly. We saw significant selling coming into this. We saw the announcement from Michael Burry that he's taking shorts on Palantir and Nvidia. So we saw major selling for the big tech names. But we just come back off we've just come off the back of a handful of really impressive earnings from some of the Mag 7 names. So do I think this is a justified move that's suddenly going to roll over in its entirety? I wouldn't. I know that there is significant risk that when these earnings start to turn and we see the growth rates coming off in a meaningful way, then we could see a really significant pullback for equities. But that's not happening. The earnings remain very strong, and therefore this pullback looked a buying opportunity. It tagged trendline support and closed significantly higher from that low, and that was the Friday. So yes, over the course of that weekend, we then got the announcement of the shutdown, but we also got the announcement of the $2,000 tariff stimulus checks from Donald Trump over the course of the weekend. So whatever it came down to, whether it was a shutdown or what, we've seen that pop. Now we're starting to fade somewhat. I think that fade is likely to come into, especially if we complete this sort of near-term head and shoulders formation here, then we could come into another sort of pullback phase. Let's see here, and come into this area somewhere around here before the bulls come back into play. There's certainly some jitters still. And Michael Berry, like I said, I think had a significant role in this because there have been question marks around valuation. So the idea of a legendary investor that's called a previous market collapse, betting millions of dollars on it happening now, well, that's not necessarily great news in terms of sentiment. And he's now saying he's got all this new evidence that he's going to show everyone on the 25th. So that provides a little bit of a cloud that's going to loom over tech stocks over the coming 2 weeks. So if we do break through support of 25376, it points towards a bit of a pullback into here. But really, unless we see this trendline support and 24600 taken out, I think near-term pullbacks are likely to be bought into. And in particular, if we rise through that 25752 level, it gives us greater confidence that the worst is over. Like I said, gold doing really well. And it's notable here, this is where the shutdown started. Look at that run up all the way up to the record highs just below the 4400. We then saw that pullback around that US-China deal. But, I don't think because we've got a bit of a deal with the US and China that all of the problems are resolved. That deal could fall over at any time. We also have the fact that central banks around the world are favoring gold right now. And essentially, the constant ramp up of debt means that this story isn't going to go away anytime soon. Look at the rise that we've seen here. So we saw the pullback into the 38.2 fib. We've seen the symmetrical triangle, the break higher from that, the breakthrough resistance of 4046. And now we're just seeing shallow retracement pop, shallow retracement pop. So I'm expecting us to see more of the same, really. And despite the fact that we've got the resolution to the shutdown, I don't necessarily think that the story's going away. This is just indicative of the breakdowns that we're going to see and continue to see in Washington and the volatility in policy that comes out of the White House. And then finally, the US dollar, notably the end of the shutdown comes alongside another sharp move lower for the DXY. So we can see here more recently, we have got this sort of uptrend playing out. So there is a chance that we're pulling back into a retracement. Let's look at that from a fib perspective. That line should be down there. There we go. So we're sort of coming into the 61.8 at the moment. Below that, we've got 98986, which is a 76.4 fib. Certainly, if we break the 98.565 level, then it points towards this rebound being over. And if we look at the wider context, that comes at a really interesting point because we're potentially basing here and a break through that 100 level or 100.3 certainly gives us greater confidence that we could see further gains coming into play. But at the moment, we've respected resistance. We're starting to pull back. We've come past one fib after another. We have still got further hurdles to come. But certainly keep an eye out for this over the near term. And the fact that the end of the shutdown doesn't necessarily bring any confidence for the US dollar is quite telling in my mind. I hope that's been useful. Make sure to like, subscribe and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets.